Good morning, traders. Good morning, Stelios.
Good morning.
Yeah.
Hello.
Anyone else around? Because I don't see the participation
I
list.
don't see Steve, no. So
Okay.
me and you for now.
Okie dokie. It's a duo.
When's is Ryan back next week?
Next week, yeah.
Good. Okay.
Yeah.
Coolio.
He'll be back. He's helping out at the Scouts camp, I think.
Yeah. He'll be back. I'll be back.
Yeah. Providing his ribs have healed. Yeah. Alrighty. Let's move over to starter. Let's kick it off. Pop. Where is it? There it is. Okay. You seeing the calendar?
Yes, sir.
Okay. So first things first, that US CPI came in weaker than expected. Yields came off. Dollar got sold in a good old-fashioned way, and as we expected, it was mainly the on the FX side. Although Aussie, Kiwi, everything moved, it was mainly the yen that reacted like severely on the back of those numbers, came in weaker than expected, as we said. The year-on-year came in at 8.5%. The headline flat, just not going into negative, but flat. And where the core CPI was expected to rise a tad, it did not. It came out exactly the same as last week. So we saw this reaction in the yields, first of all, where the short end dropped, the 2 years dropped from somewhere in the 320s down to close to 3%. But in the meantime, we're already back to 318 in the 2 year, and the tens are already back above these 275 as well. What did you make of all this, Stel?
Well, I think the market is quick to celebrate, right?
Yeah.
To say that we're at peak inflation. Joe Biden said we had zero inflation last month. Last month, celebratory fashion. We forget obviously that prices have gone up a zillion % in the past few months. But anyway, the markets always want to celebrate, and they liked this downprint in inflation. The question now remains: what does the Fed think of it? And the first indication we got from a couple of Fed members, Kashkari and one other who I don't remember, they were both a little bit more hawkish than expected. Kashkari actually said he expects rates to be at 375 this year and 425 next year or something like that. So the peak in rates is higher than what the markets are expecting, according to him. And the other Fed member, whose name I forget, also, said that projected higher terminal rate than the market's expecting. So the Fed is still not, well, from what they're telling us, they're still not convinced. And that's a question, because the market can decide what it wants, but the question remains: what will the Fed actually do?
Exactly, and I completely agree with that. And we actually said it before, right? The market is going to be very happy with a lower print, and that's exactly what happened. The S&P shot through 4,200, went up to 4230s overnight. Dollar yen got an absolute beating from around 135 down to 132. And then euro dollar went to test the 103.5 level, and especially the commodity currencies as well went absolutely rocketing. Kiwi in the lead. So the market is absolutely celebrating anything it can get its hands on to not to have to buy dollars, it seems. Okay, that's what happened. And now I think the dust is slowly settling down. We still saw some dollar selling coming in early doors this morning. I think there's what we are going to see now, likely, unless we are going to start printing higher levels in the dollar in general, is that we may see some more model funds getting involved, because they are seeing lower prints on the dollar, and whatever the actual atmosphere would be in the market, or whatever yields are doing, the FX momentum models will probably still sell dollars unless we get stronger closes than the day before. So we have to take that into account, in my opinion. You can fight the dollar weakness. I'm not really fighting it, but I do respect this euro dollar 103, and I will show it a bit later on the charts. This 103.50, and then there's another 103.70 in there, which was the cap yesterday. I do respect it. I do look at the yields, which are gradually coming back to where they were before. Because of those Fed comments, who say that the battle against inflation is not won, and we tend to agree with that, I think, still, and we need to see several prints of several lower prints to really say that inflation has peaked. I mean, everybody is saying that the inflation has peaked, but we will have to see what the energy market does, what the commodities do, and we'll make. I think we need an extra print, at least one, to say that inflation has indeed peaked. Of course, I mean, a lot of people will call it now that the inflation has peaked. I've seen so many comments saying that yeah, that's it. We're done, and the Fed will have to slow. But the Fed members themselves have not yet told us. Evans came out the first one saying that he expects the rates to end the year somewhere around 3.25–3.5%, which is 1% higher than where they are now. Fed funds are at 2.25, 2.5. He's a neutral guy. 1% is perhaps is less than what the market was trying to price in before. The market was trying to price in 1.25%, but it's a bit logic that we saw this repricing. So his 3.25–3.5% could be on the money. But then the interesting add-on, what he added on to it was that, yes, but we think we are going to 4% in 2023, and that's where the divergence with the market is now appearing, because the market, or at least the inflation peak callers, are saying that in 2023, the Fed could start to pivot and start to actually stop or even lower rates. So the Fed members are far from that, right? So next, move on. I want to also mention, as I said yesterday, this 10-year note that came out right after the CPI. It did go through the when issued rate, which was 276.5, if I recall well. So we did go through just 1 BP, and the external bidders came in force. So we can call it a good auction. On the other side, we can also say that the market is indeed thinking that there might be somewhere a pause in the longer end of the curve. So we have to pay attention going forward to those auctions again. Anything else about it? And before we move on, I think we'll talk about the market moves just after.
Yeah, I don't have much to add. I mean, apart from the CPI yesterday, it was and the Fed speakers.
Yeah,
it was pretty quiet. No, nothing really. Sorry, it's
yeah. In the other in the other news, then what came out yesterday, or the data, we saw a big build in the crude inventories. It did send, well, actually oil went lower before it, and then it did send crude prices a bit lower again. But today we can see here, today we are back to what actually is close to a breakout level of the 88, 90, 92, 93 range. So the market does say that the war isn't over until it's over, right? So it's interesting to see that the crude market is discounting these rebuilds. They probably people were probably expecting some of it. So elsewhere in the news, we saw a bit of a move on, and again, it's on the move on the dollar China, and I will show the chart lately, because the US is putting the China tariff talks on hold because of the Taiwan situation. We know that the US has been thinking of ways to bring down inflation, and one way is to cut tariffs on some Chinese products. But now with the Taiwanese situation heating up, they have put those talks on hold. So as a result, the Chinese yuan, who gained about three quarters of a percent versus the dollar yesterday after the CPI, is slowly crawling its way back up, and we are at an interesting level here, which I will show on the charts in a little bit. The other one, which I felt interesting, was that last month the US saw a much lower budget deficit, and that's thanks to the COVID expenses falling. But since there's quite a bit to do about deficits and how much the Treasury will have to issue more because of Biden's health and tax and climate plan, that may help them actually not to have to issue too much. So keep an eye on that one.
Define how much. Define
Sorry?
how much not too much is.
Come again, Steve. I didn't get you.
Define how much not too much is.
Yeah. Well, I mean,
because budget deficits keep increasing, year by year. Yes,
they are.
There has been a temporary pullback, but not in comparison to the pre-COVID deficits, right? Just in comparison to the COVID deficits that were, even further inflated by one-off things. But, if we exclude the extra spending and extra deficits for COVID, annual deficits are actually continue to go up if we take the trend all the way to 2019. So I don't think it's going to be easy.
And $1 trillion deficits are now the norm, which is crazy. But yeah.
Well, and good morning, Steve. But my view on that, right? MMT is well and truly there. Only the baby hasn't been given the name. I'm not sure whether deficits are really going to affect the market, or when they will, we will hear about it. But it doesn't seem that markets are trading them at all, right?
Yeah, you know how it is.
Yeah.
Markets,
until they will.
Markets heavily traded on these type of data until a few decades ago. And it's inevitable that markets will start trading based on that data because that's sound economics again at some point in the future. But for the time being, as you said, markets seem to be considering these type of data, of very, very low importance.
Secondary.
And until they start caring again, of course, after some kind of a big market event.
Yeah. All right. Thanks for that, Steve. Now, next, in line in the data, all the data as well were mixed with European CPI data, but we mostly covered them. They came out relatively as expected, but comparable to the US, which slowed down a bit, and I think that's part of the euro move as well. the French, Italian, and German CPI were holding up. But we'll come to the charts in a little bit. So today, what's next? For those having Maxim in the books, we've got the Mexican industrial production coming up. They are June numbers, so a little bit delayed. We're expecting them to be to come out a little bit stronger. Interesting with the dollar mix for those trading dollars is that we are trading right around the 20, the big 20 the figure level. We went below a little bit on those dollar sales that we had after the US CPI, but it can put a bit under if they don't show an improvement as expected. I'm rather still in Euromex. I'll come to that a bit later. So we have later on today the claims. They have been steadily on the rise. We have to take those into account, because if they continue to rise, it may finally start to have an effect on those NFP and the labor reports later on. But the thing is, in the labor report, as Stel was already mentioning yesterday, there was people taking second and third jobs. So you could see those jobless claims even rise, but with an NFP which not really showing it, right? Or at least the jobless rate unless we look 2 or 3 months ahead. The next one is the PPI. We've seen elsewhere that PPI outside of the US has started to show signs of topping as well, especially in the one we had in China earlier this week. So we are expecting a bit of a slowdown here as well. It could give a little bit of a second wind to the dollar moves we have seen yesterday, if indeed we get a bigger slowdown as expected. So watch those things. I personally think they are a little bit secondary and more volatile. So it could be more of an algo reaction than a real market reaction. Again, I will use the yields as my guide for what happens post those PPI data. And we have a few more auctions today. We've got the 30-year. It's a smaller one in amount, I think. Let me quickly verify that. If my page loads fast enough. Was it 30-year today? No, it's a 21 billion. No, that's not the one. Yeah, it's the one. It's a 21 billion, so it's a bit smaller than the 10-year, right? But anyway, keep an eye on that for the longer end of the curve. If nothing else to mention, data news-wise, we'll straight move over to the charts and look at a few currencies.
Yep.
All right.
I don't have anything to add.
Okay. Let me. All right, here we go. So first of all, the euro dollar. So we've seen the channel here being tested thoroughly yesterday. The magic 103.5 level gave way for an hour or so, and then but we stopped just shy of this 38.2% here, and then here, which I find a little bit more interesting, is that since the break of the big 108, we had this retest of which came just shy of 108, and then we had the final leg down of the euro to below parity, and yesterday we stopped right on the 50% retracement of that move. I will really keep an eye on that one. I did sell a small euro dollar yesterday around this area, took some back on the dip, but I will respect this 103.70 as well. So this whole 103.50, 103.70 area to me is going to be important to close the week. Basically, if we close above next week, we could see a move higher again into the probably the 104.5. Why not even to 106 if the euro is really gaining strength, and it will likely be also because of the dollar being sold off. So as I was saying before, watch the some of the hourly moves, watch the 8 a.m. London morning moves, where the model funds are very much involved in the trading. They are pretty directional for the early days move. We have seen this morning where euro dollar was trading around 103, the figure, or even a little bit below. Once they came in, that's the move that put euro dollar right here, and also which had the dollar yen come off from 132.80s down to 132.40s. So I'm watching this level. If ever we close the week back below this 103.15.35 zone, I reckon then we are going to range trade, and possibly range trade for the rest of the summer, or at least until Jackson Hole, which is in 2 weeks. Is it?
20 something. Yeah, probably around 2 weeks. I need to check, but it's coming up in a
Jackson Hole, August
20 something.
Let's see when that is. 17th.
Oh, 17th. Wow, so next week.
Oh, no. All right, we'll come back onto that. It's a different stuff.
25th, 27th. Thank you, Gavin.
Yeah, okay. Thank you. Oh, lovely. Thanks, Gavin. So if we start to fail here, I think we are going to get back into this range, and then just trade ranges until Jackson Hole. Again, my main focus will be for one, the yields, and then secondly, we have to take into account as well what the equity markets are doing because of the correlation. If equity markets continue to rally, which I put a bit of a question mark on that right here and now. But if they continue to rally, it has de facto a small weakening effect on the dollar as well. But interesting levels here. Moving on to let's grab the cable. This cable, there's an interesting little channel going on here. It's starting to be watered down a bit, but I would additionally put a resistance level around 122.90, 123.15, which has been tops before as well. But we could be in for a test if this on a close, if we stay above 122.25, 122.30, perhaps. If we start to fail, move back to 127 is not to be ruled out. But again, we don't hear much right now, sterling wise. Yes, there's always these debates or news interventions coming through, Truss versus Sunak, but I think the market pretty much knows what they both have to say, and it's likely going to be the dollar which is going to be the driver for this pair. I'm going to have a quick look at the euro sterling though, because this one here, we've broken below this support line earlier in the month, and yesterday with the euro's advance, we tried to move up above again, but for the time being we're hanging around there, and we're trying again. So if we start to close above where we are now, we start to get closes above there. there is a chance perhaps of this euro sterling going back into the 85s. Still, did you have anything running in that still, or?
No, I had the small long which I got out at almost break even. But I still think it's going higher, but I just didn't get my entry level again, so I missed that.
Yeah, and let me ask you a question, if I may. I'm not going to try to do like Blake, but would you think that if euro sterling is to move higher, would you think it's sterling weakness or euro strength?
I think it's going to be both, actually.
Yeah.
But I've said for a while I find very few reasons or almost no reasons to be bullish to the pound, apart from a hawkish Bank of England, which we did get momentarily when they hiked 50 before they then went into to sound really dovish. So I think it's going to be a combination of both euro strength and sterling weakness. And I know when I say euro strength, people think I'm crazy, but I think we're going to see a little bit more of euro strength, and I do think the euro pound is going to edge towards 90 eventually, and the euro dollar also is going to be edging higher. Now, don't ask me what I think is going to happen in a year or two, because I think eventually the euro is going to have a very, very tough time. But for now, I think the path of least resistance for the euro to go a little bit higher.
Yeah, I think if ever we are getting to 87 in euro sterling, if you look at the more medium term like you are, there's going to be a fierce battle around there, because it's not only a 1, 2, 3 quadruple top there, but we've also got a little bit of technical resistance there. It's going to be a fierce battle if ever we make it up there. If that breaks, then I think your 90 will stare us right into the face, indeed. Alrighty. On the other hand, yeah, and talking about the sterling, it's interesting how Bailey is fighting against what Truss wants the Bank of England to do if she's getting the premiership, right? He's really fighting against it. He doesn't think that they should change the Bank of England's mandate just as of yet. Over to the dollar yen. Hello. That was like a big break. We were talking about that 134, 35.40 yesterday, which was a fib support, which was the neckline of this inverted head and shoulder. It was also levels where we traded around before already, so it was really a big level. We had the break. I had an entry break stop there, which luckily was done, by the way, because sometimes brokers can go like absolutely crazy and not even do stops. I don't have guaranteed stops in there, so managed to take a fair bit of the leg lower in this. But then around here between 132.80 and 133, really, I took profits on all this, and then started to get a bit long just around this line yesterday over the fixing. The base position was about only half of what I usually would have, because of the volatility in this pair. But then I managed to leg some out back in. I think we're going to range trade a little bit in this one. What I was going to show is that we have this inverse head and shoulder, but if we look at this, we could be building another one. A regular head and shoulder now, and that would mean that if ever we get a retest, and here we are again on because the shoulder is around this 134, call it 35.50 again once more, and that to me reinforces the importance of this 134, call it 35.50 zone if ever we'd make it back up there. It does look like already being offered around the 133.34 now, and we're trading around 132.60. But never say never in the end. It's a volatile pair. I think if the US tens would start to move back above 280, why not? You know, I mean, looking at the volatility, it's very possible to go for a retest. But I would really pay attention to this 134, 35.50 zone. I can't stress it enough. It's big. The reason why I'm also keeping a bit of a long. Hang on, let me. Change this a little bit to not overload the chart. Is this this is the daily Ichimoku cloud on the dollar yen. The bottom end is at 131.70. As I've been saying before, the Japanese really pay very close attention to clouds. Okay, we've dropped below on early next week, but then you look at the close, it was back inside. So this is the one that I'm playing right now. Bought the low 132 yesterday. As I said, I'm not shy of trading it around because of the volatility, because of like when it goes like 40-50 pips. I like to trade it around as it improves my base average quite a lot. So, and this is the one, if we start to close below the 130-170, I think dollar yen will have potential to go back down probably another three, four big figures back into this prior zone from where the last jump started. So this is the one that I'm keeping attention, close eye on. And then the top end of the cloud, which is gradually moving higher because of because of this move, is well quite close to where the famous 134 35.50 lies. So this is going to be another case of watching this level closely. If in the upcoming sessions we make it back up into the mid 134s. So that for the dollar yen. Metals disappointed, no, Stel?
Yeah, they're underperforming. It's disappointing, but yeah. Let's see. I mean, I guess the reason why they're underperforming is because real yields are dropping. So I mean, sorry, real yields are going less negative, right? So you have inflation dropping, and you have the 10-year actually edging higher a little bit. So not dropping, sorry, going higher. So obviously, you know, it's a tricky one. You know, I still believe in metals in a big way, but in the short term, there are sellers, and you know, they tried to break out yesterday. 2070 was the level in silver. It touched it. It went a couple of cents above, and now it's back below. So you know, still watching that. Still, luckily, comfortably in the money on my long, but you know, I would have loved to have seen the breakout.
Yeah, Steve.
Yes,
Are
mate.
you around?
He's just polishing his gold coins.
I've been eating quite a lot, so I'm round. Yes.
This is your trend line, mate. So what do we do with it? As long as we're above positive, or are we neutral on this one?
You know, I've actually drawn the line a little bit different, so we haven't broken above it yet. Okay. But it doesn't really matter because the bottom line remains the exact same one, meaning in my opinion, the markets are still undecided that gold and silver are decisively pushing higher. We're seeing a general misconception and problematic rhetoric about monetary metals. It's tails, you lose, heads, you lose again. Right, meaning we've been seeing very high inflation, and the market's reaction has been, oh, now that there is high inflation, central banks are going to be very decisive with taking action and pushing rates higher, and that's going to be negative for metals. And then when inflation does a little bit of a pullback. The rhetoric is, now inflation is pulling back. So, great. But in my opinion, precious metals are headed much, much, much higher because reality is something that you cannot avoid forever. The question, though, remains, is it from here? It remains to be seen. I'm still also long, like silver. For the time being, I'm just seeing a healthy consolidation. We're still specifically in silver, we're still trading above the broken, flag. So I think for the time being, we can still move decisively higher. I think invalidation levels in the case of silver is practically 19.5. That spike low that we had. I think as long as we trade above it, we can remain constructive. In the case of gold, I think that first of all, between the two of them, I'd rather be long silver, right? No questions asked. Now, in the case of gold, I think 1750, roughly that area is now the level to watch for bulls. So, bulls have to defend 1750. As long as we trade above these two levels, I'm still rather constructive, but, clearly, gold and silver have more to do before they actually prove that they've 100% bottomed and we're headed higher.
Okay, thanks. Yeah, I've yesterday actually I tried a little momentum trade when it broke above this 1803, above 1800 basically. I tried to buy it around 1802, watched it go higher, but then fail here, and I quickly went out of it because it didn't look like, and that was around the time where euro dollar was also trading on this 103.5.
Yeah, in my analysis and in the weekend analysis and last week as well, when you were away in the flow, so the level I've been giving for gold, like the bull bear line for me, has always been 1804 specifically.
And there's the one, huh?
Yeah, that one.
There's the one. Absolutely.
So,
Thanks.
until we break above it, I'll still remain somewhat skeptical.
Yeah,
right?
Break and hold.
Yeah, of course. For
That's
me,
the important thing, because
for me and my trading style, as I've explained multiple times to people, I watch at daily charts, right?
Yeah.
So I don't really care what happens intraday, because very frequently intraday movement can be just noise, right? For me, all that matters is the daily candles.
Yeah. Okay. Yeah. But that depends on each person's trading style.
Yes,
and
of course.
the time
But,
you can spend.
I have to do me, right? So whenever I explain things, it's from my perspective, right?
Yeah, absolutely. No, so that's what I was saying yesterday as well. To me as well, this 1804 is pretty important. I gave it just a quick try, but then gave up. Cost me $1 or so. I drank one less coffee this morning. But okay, to me this line is relatively important. But as Steve said, there's this one here as well, around 1755, which I've been always watching as well. And we saw a breakthrough, come back to test, and then the move up to 1800. Maybe a bit of range trading here, depending what goes on in the rest of the dollar world. Now, in going to silver, as I was pointing out over the prior flow shows, and I'm sure you guys did as well. So, and yesterday we spoke about this flag. The flag is still valid and broken. So anywhere 2030, 2025 could come in as a bit of a support. Actually, no, we haven't been there this morning. But to me, the key really, no, that's me personally, but the key really to silver really exploding is going to be this 2085-21 zone. If we get back above 21 and hold, and we keep on saying it, but there's so many saloon doors in this market that we have to be careful. If you try to go directional or momentum with a trying to catch a trend, make sure that it's not just a break and then comes back below. If it holds, then you can really start to build on it and accompany any move. So whenever you trade hourlies or 4 hourlies or daily or even longer, it's always the same thing. Don't just have to watch out for saloon doors, because they can really tire your account if you take too many of them in your face, right? So then another one, which there was a lot of talk about this one, is the S&P. The 42 level, 4205, it's there. It was kept for a while. Then we went up to this. The trend line here came in at, depending on which point you take, around 10.13. Yesterday, it's around 42.15. This morning, it's trying to hold, but I want to see what the American market is going to do with it this morning. There's various resistance levels here as well, around 42.30, 42.60. Still, you were talking about 42.45 this morning in the chat room. And any reason why specifically that level? Because unless I'm blind, I don't see it.
No, I was saying short probably at these levels, between 42.10 and 42.30 with a stop at 41.45, 42.45.
Okay, all right.
That's what I was saying, yeah. It as a risk reward, it makes a lot of sense up here. It's a level that's been tested a few times before, an area that's been tested. But I said before, I wouldn't really want to go against this move that we're seeing on the back of CPI, apart from a very short-term trade. So that for that reason, I would put my stop quite tight and try to take advantage of a like a brief counter trend move. But the trend is still higher now. But I was just saying, if anybody really wants to be short, this is probably a nice area, but with a stop at around 42.40, 42.45, somewhere there.
Yeah. Okay. I tried it yesterday, just in front of the 42 area, but went out of it once this broke. Got done overnight on this one. I don't disagree with you, because
the risk assets rally is all about the market having no faith and not believing at all in Fed credibility, right? Because we've seen a plethora of Fed people coming out the past few days trying to persuade the markets that the Fed is nowhere done. You mentioned some names specifically, even Kaskari, that is
the ultra dove is now very hawkish.
The most ridiculous dove I've ever seen on any central bank is coming out and playing the super hawk, right? In comparison to the rest, of course, because there's no hawks in central banks, right? It's just a variety of doves. Some of them super dovish, some of them less super dovish, but all of them are dovish, right? In comparison to what was considered dovish and hawkish in the past. So now they're coming out all in tandem, trying to persuade that we're nowhere done and we're not going to declare victory just because we had a little bit of a pullback. But clearly, the market doesn't believe them, right? So one of the two has to give, right? Which of the two we're going to find out. It's either they prove once again that they say one thing and they're going to be doing the other thing, which, let's be fair, that's what the market believes is going to be the outcome, right? Or they actually mean it, in which case, once the market realizes that they actually mean it, it will have to do a lot of repricing, right? A lot of repricing having to do with risk asset prices.
Yeah, and actually the way that the equity market and let's take the S&P as the front runner or the main one. The way the market trades is actually telling the Fed that they don't have to stop at all. Everything is going for the best.
And by the way, Lucas, I appreciate your comment, but I don't agree with it. That's the point, Steve. Nobody cares about what they say. Market cares about data. The thing is, if we focus strictly on the data says the following: inflation is 8.5%. That is more than 4 times the target. So if they only cared about the data and not the Fed's response to the data, even with inflation easing a little bit, if I can even use the word easing, to 8.5%, stock prices should still remain heavily under pressure, because they should be, the market should still be pricing in a lot of hikes and a lot of quantitative tightening to come. The thing is, though, that the market responds to what they think the Fed's response is going to be to data, right? Because there's a big difference between the two. The market doesn't respond to data, it responds to what they think the Fed is going to do with that data. And there's a big difference there.
Okay, and speaking about quantitative tightening, don't forget that September they will double the amount of the tightening that they put in place, right?
Yes, it accelerates from 45 billion per month
to
90 billion. So practically, in 20 days from now, the pace of quantitative tightening doubles.
Yeah.
Have they actually been doing that, or is it something they said they're going to be doing, but they're not really?
No, it's been in place. Well, I mean, it's there. I've seen it on the New York Fed website. So that's their trading desk. That's what they will be doing. Okay, but all right, but what I do read on the other hand is that the banks have actually deposited even more lately, which is a bit counterintuitive. So the effect of quantitative tightening so far is negligible, but I think that is about to change in September.
Don't forget that practically, even Powell admitted that they had a very slow start to quantitative tightening, and by slow start, he didn't mean that the 3 months of 45 billion were slow. They actually didn't even make a 45 billion tightening per month, at least not until like a couple of weeks ago. So, and Powell admitted to that. So if they actually want to follow through, they have some more selling to do by the end of this month to catch up with the target, and then doubling the pace to 90. And it will start mattering, right? Draining liquidity out of the... Sorry, what did you say, mate?
I do think so, yes.
Yeah. I agree with you. So once, especially it accelerates to 90, if they don't do an about turn, it will start mattering, yes. Especially if at the same time, they keep on sending the same messages having to do with the rest of monetary policy, right? Let's see. So, as I said before, there are 2 possible outcomes. We're currently seeing a divergence between what the market thinks is going to happen and what the Fed is saying it's going to happen. And at some point in the near future, within the next, I guess, maximum like 1-2 months, we're going to have to see a divergence between the two.
Yeah,
and
absolutely.
That's going to produce some interesting moves for us traders.
Yeah, absolutely. I agree. Alrighty, because we're already nearly 50 minutes in, let's quickly rush through a few others. So the China, as I was saying, US has put the discussions on Chinese tariffs on hold. That's the news that we got overnight, and where due to the dollar weakness, dollar China dropped below this wedge. We are now retesting it. We are right on it actually. It's
just a
trading.
fundamental comment on that. You remember when Trump was trying to persuade people that Chinese are paying the tariffs, right?
Oh yeah, I mean we see now who is paying the tariffs.
Yeah, which was a ridiculous notion. I was explaining that back then because I have no political stakes in the game. I will say whatever is bad or good, in both sides of the aisle. And I was explaining to people back then just, what Trump is saying is ridiculous. Tariffs are being paid by American citizens. And of course, there is an open admission for it, because when you say, I'm thinking of removing tariffs so inflation goes down, right? It's of course an open admission that yes, inflation can somewhat be helped. I think the effect is going to be rather negligible, but in any case, it can be helped by removing tariffs, because who was paying tariffs? American citizens were paying tariffs. They were added to the product's price, right?
Yeah, absolutely. All right, so this one on the technical side, we have to pay attention a little bit to this 670 low 674. Seems to be rejected a bit now as well. But I think if there's more, because the COVID cases in China are alarmingly rising at an alarming rate as well. Personally, I'm still want to try and get long again, but perhaps if this continues to be rejected, we'll have a chance to buy it under 670. Then moving on to the MEX, as I was showing here, 1998, 1999, moved below a little bit, but since this bigger triangle has been broken, I still think the overall direction is to be down, but I wouldn't rule out a retest of 2020s at some stage, if ever the US yields can hold and move a little bit higher again, just as a reaction of this 2020 level in the dollar mix. Overall, as I said, with this lower CPI print, but we need to caution this because we only had one lower print. But overall, we have a clear divergence in interest rates as well as that the Mexico deputy governor yesterday came out saying that they will continue to raise rates. So a little bit in line with the Fed speakers. The guys of the Central Bank of Mexico said that they will continue to raise rates. So I do think in over the medium term or so that will continue to support the MEX. I'd rather still trade Euro MEX. I still think if we look at the picture over the past weeks and months, it's the direction is relatively clear to me right now still. For as long as we are below this 21-20-25 zone overall, but for the time being, we're struggling to get even over 21. I think we will have a chance at some stage to revisit 20, but that's my opinion, of course. I'm still very small for the time being short, but I'm ready to add on Radix to that one. I saw yeah.
Speaking of which, mate, Mexico has a very, very similar inflation rate with the US at the moment. Mexico actually has a little bit of a lower inflation than the US, even despite the little pullback we've seen in the US. And Mexico currently has, if I remember right, close to 8%.
7.5, yeah. Or something, 7.5 or 8, yeah.
775. 775, if I'm not mistaken.
Yeah. And that so the MEX favor.
Yeah, so think about it, right? Similar inflation rate, actually Mexico having a little bit lower of an inflation rate and more than double interest rates.
And as a result, they have higher real interest rates, which is attractive for investors. and
significantly higher in
of
real
the
interest rates.
of the US. If the US wants to get closer to home and steer away from China, the MEX may even benefit even more from it. So I think there's a lot to go for the MEX still right now. Okay, the dollar Canada. I saw a question on dollar Canada yesterday. I was saying, I mean, that it would be one of my least favorite to trade because of the proximity of the US. We did get a pretty decent move on the dollar Canada. I'm still not convinced. I really want to trade much of it. If I want to trade Canadian dollar, I'd rather let me clean my chart up just this tad and then include this move. Yeah, see, it's really, it's not respecting much on the technical side, but what I do think is that Canada somewhere should also, unless the dollar outperforms or underperforms, which is doing now, I think that Canada is more of an interesting play through crosses than really versus the US dollar due to its proximity. Also, not forgetting that Canada is also a beneficiary of the EU's search for energy, and since the costs have risen and are rising, in my opinion, Canada, I can't really sell Canada as such right now, the Canadian dollar, but to me, it's a case of finding the correct currency to sell it against, whether it be yen, whether it be still euro or another lower yielder in a way. Remains an open question, but I'm not really specifically looking at trading a lot of dollar Canada. But this is probably going to be a small support right here, which has been building. This is a trend line over the past 2 weeks. So the 127.5 is a bit of a level if you want to look at the dollar Canada. All right, I'm just looking at the time. Hey Steve, you're short Canada yen. Is that because you think the yen is strengthening or because the Canada is going to weaken? In the meantime, I think this we can call it a day. We're not going to hold too much more of your time right now. Thanks everybody for joining. Just make publicity for us. The more the merrier. The more interaction, the better. Steve, Stelios, thanks so much for being part of it again and helping me getting through the show once more.
Thank you, Cayman. You're very good as always. Excellent analysis.
Thank you. And guys, so watch that PPI, watch the initial jobless claims this afternoon, trade safely, and hopefully you make a gigantic amount of pips.
Just a heads up that OPEC is set to issue their August oil market report tomorrow.
Have a wonderful day.
Yeah.
Bye-bye.
That's 1:15 London time.